What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 30th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we're going to be talking about three major topics. We're going to dive into the technical price section here for crypto and stocks. We're going to spend some time to talk about the fundamental situation we are in between inflation and the Fed, and finally, come in on the big topic that no one is talking about at the moment. We've got a lot of things to dive into in today's video. If you happen to like it, consider dropping a like, and let's go ahead and kick off the rambling here. So I want to first start off by taking a look here at the Bitcoin chart. Now, as you all know, we've been calling for Bitcoin to move down since our Macro Mondays that we put out back, I think, probably about a week or two ago. We put out our new price target here in September that sometime into the following weeks we're going to come down and retest the 14K price level. I know so far we have been pushing sideways here. We haven't made any substantial move higher nor any substantial move lower, but I want to drive home a very critical point here, guys. When we set out these price levels, they're not set for a 12, 24-hour time frame. There are things that we're watching here for the coming weeks. And to be honest, there's a lot on our side here when it comes to this argument. I know a lot of people are thinking that this looks like a bottoming process, but I gotta be completely candid with you guys. The TA does not show it here. We have had continuous lower highs here since as far back as June of 2022, when we had the failed attempt to make 30K support. And since then, while we have been having consistent lows here, we need to get above this level here with a close or two above this line of current resistance that has been holding us back here since June. And if we cannot, if we come up here, even if we get a short-term bounce like we did back between September 9th to the 12th to the 13th here, if we get another flush down here, we don't have much range to go down before we start to knock down and deviate below the previous range of support at around $19,000 here for Bitcoin. Now, if we take a look at Ethereum, same exact case scenario. A lot of people are excited right now that price is building support on previous resistance. And yes, that is one of the first things we want to start to see for a trend reversal. But for us to get excited at this point, to take advantage of the supposed discount opportunity, and to get excited for the next bull market and next wave, we want to see a pair of higher lows and higher highs. That is the definition of an uptrend. We have not seen that yet. And if we dive just a little bit further here when it comes into Ethereum, we need to look no further than the ETH to BTC ratio, where we've not only been seeing a substantial decline here from the previous relative highs, down 20% here since back here in early September, around the time when the merge launched. But on top of that as well, we're seeing clear signs that what usually acts as support during bull markets, the 200-day EMA and 200-day moving average, are now acting as resistance here. Clear resistance for more than an entire week as we go throughout the close of September. This is showcasing here that the bears have control over the trend, that Ethereum was likely overbought going into the merge. It was one of the few plays that was really outpacing the market, and not to mention one of the more concentrated leaders in the market, being the second largest crypto asset. But now we are seeing that the bulls have not been able to show up and continue the trend here. There is not much fundamental momentum coming into the merge here, and this likely speaks that we've got more capitulation to come in. One of the really telling things here is our data science partner, Quant. Now, if you guys haven't checked out Quant, I definitely recommend you guys check out the link down below in the description. Utilize them as one of your data science tools. It's one of the major key things that I utilize to go through my technical analysis, my data science analysis, and really try to understand where the market is at the moment. And essentially speaking, one of my favorite indicators here is the net unrealized profit or loss model. But more specifically, we're looking into a fraction of that model, which is the net unrealized loss, or NUL. And this is essentially taking the on-chain information, the unspent transaction outputs on the Bitcoin network, all the Bitcoin that exists out there. And it tries to understand when it was last moved. And when those Bitcoin were last moved, it tracks the price. It weighs it out across the whole market, and essentially we can figure out if more or less of the market is in a phase of capitulation. Right? If they're in a phase essentially where they are at massive unrealized losses or gains. Now, when we're at the vast majority of Bitcoin essentially being at new all-time highs, you're going to have low levels of net unrealized loss because everyone's winning, right? Everyone couldn't have bought Bitcoin at a higher price because we're setting new all-time highs. Whereas when we're going through capitulative events, when price moves lower, net unrealized loss shoots up higher. And we've seen that a lot of people are getting excited. A lot of people prematurely were yet again getting excited that, oh, look, the net unrealized loss is starting to decline. Here as Bitcoin's price moves up. We found the bottom. But yet again, we've rolled over here, and NUL is now coming back up. Now, if we can take inspiration from previous moves here, I think one that is very similar to what could play out is what happened here in 2014 to 2015, and one of the more extended and more brutal bear markets in Bitcoin's history during the collapse of Mt. Gox, a Magic the Gathering online exchange, which was a huge disruption to the crypto space, and the continued lagging bear market that really dragged out Bitcoin's price to the downside and gave us one last final capitulative wave here that really sent net unrealized loss shooting up higher. I think at a minimum here, we are going to be seeing that higher range here for NUL going up here at a minimum on the left-hand side ratio here to 0.5 all the way up here to potentially 1 point, similar like what we saw back here in January 2015. Why are we so confident on this? Well, to wrap up our conversation here around the technicals, we need not look any further than the weekly time frame for the major stock indices. We need to be looking at the stock market for a guide here, because if the stock market is going to get weighed down, at least according to the correlation we've been seeing, a strong one that's been holding for over a year plus now between equity markets and crypto, we need to understand if equities are going to be going down, crypto is going down, and vice versa. The moment equities are starting to show us signs of strength here, and that we're going to continue the secular bull market we've been in for the last decade, I'm going to get excited about crypto, right? So again, I want to make it very clear, I'm not just some perma bear, right, just because it's the convenient or fun trend to be in. It's because of the fact that the market is screaming certain signs here that it wants to move lower. Let's go ahead and dive through those, okay? Now, when we take a look here at the last decade, we can see one clear, obvious thing, that the 200-week moving average, this orange and blue line here, this is the difference between the exponential moving average and the standard moving average, right? Now, these two indicators have been buy the dip opportunities so far. For the last decade, it's been stupid not to buy at these ranges, right? It's been a point where it's time to go all in this case, right? Because we always knew that the Federal Reserve would come to the rescue. We'll talk about that with the fundamentals later on. But at the same time as well, right, it doesn't mean that it's always been the case. While it has been this way for the last decade, we need to understand that in periods like 2008 or here, like 2001, these metrics were broken through. And they weren't just broken through by about 1 to 5 to 10%. They were broken through by 20, 30% or more. And in the grand scheme of things, if you've been holding positions from the top, that weighs a lot heavier at the end of the day. It is important to understand here that these kind of declines are not just some rarity in the markets. They are very much the norm here, especially after extended runs in valuation. What we've seen here has been a blessing in disguise that many people have just simply gotten used to. So if we start to see these metrics serving as resistance, or simply put, start to be broken through like they were here in 2008 during the summer, when we get a potential bump up after a set of new lows and we can't reclaim that level, that is going to be your telltale sign that things are about to get disastrous. Or for example, like here in 2001, in March going in here into May, we got a bounce above this range, but it was a deviation, a short-term bounce up here, just a couple of weeks before we started to roll back down and yet again continue with many more declines. So again, it is important to understand here that the metrics that define bull markets will start to act as resistance. And while the 200-week is where the bulls are still holding on to some kind of hope, we need to understand that on the shorter time frames, we have been seeing that time and time again, the bullish indicators are starting to act as clear signs of a bear market. Take a look no further than at the 200-day moving average, right? Again, another indicator here where if you bought below the 200-day, good news, you'd usually be buying it at a great discount, right? But what we're seeing now is a very clear difference here. Each and every time we'd usually come down below this indicator, we'd usually deviate back up and continue the trend. But we've got a serious problem here. We have had multiple reattempts at the 200-day moving average, and we get shot down every time. It is a clear indicator for market participants and traders who are riding any relief rallies in the market to not see them as new bull markets, but to see them as good short-term profit-taking opportunities or areas where people who wanted to get out before now can start to get out in the market. This is a clear sign here, just like in a bull market with higher lows and higher highs, that in this case the bears are in the lead here with lower highs and lower lows. As we can see, while the highs here are relatively lined up, the new lows are starting to go down to much more exacerbated levels. And it will shock a lot of market participants. It may not come tomorrow, but it could come in the next couple of weeks. Again, it's not so much about time here. What we're trying to figure out is whether or not it's an appropriate time for us to enter the market. Same goes here with the Nasdaq. We see a very similar trend here, just barely holding on to that 200-week buy thread here. We've actually gone below the 200-week here. The previous market leaders, in this case the technology companies, are now faring the worst off in the market. FANG stocks, even the strong players in tech like Apple, are starting to see serious signs of weakness, and they're underperforming against the Nasdaq for the past week or so here, showing signs that potential recessionary fears and the Federal Reserve's actions in order to cool inflation are going to knock equities down severely. And finally, on the TA side of things, before we dive into the fundamentals, we got to dive into the VIX. The VIX here has been on the long term here since 2017, screaming for a proper depression in the market. We have seen the uncertainty has continued to grow here. We've had a general resistance range here that was only really broken here in February going into March of 2020, which was, of course, when the pandemic happened. And as many of you know, the Fed came into the rescue. They saved the day. They prevented the markets from having a proper depression after a secular bull market. And what's worse is that they made matters even worse. They injected a new layer of quantitative easing. Now, I know there is some argument to be made here. I think, again, the Fed definitely, to a degree, did what was right. We needed that liquidity injection if we were going to shut down the entire economy so that things don't entirely break. But they injected way too much. And on top of that, as we discussed, the response here, again, has been a total setback for the economy. It is going to be years of irreversible damage that we are going to have to make up for financially and society, as a society in this case. But putting that aside, we need to understand that it is probably going to materialize now during a period where the Fed is not coming into the rescue. And the VIX is screaming this. It is showcasing to us that at a minimum, we are going to get another flush like we saw here on the VIX and the call and put options, S&P 500, from here, where we are at 31, all the way up here to over 70 points. At a minimum here, we should expect something like this. Now, it has gotten worse in the past, but I think that this is a good benchmark to tag for, where we can start to potentially get in a range where dollar cost averaging really makes substantial sense, where we can start to get really excited. Because again, I know a lot of people say, Nick, the point of dollar cost averaging is just to passively invest. Why are you thinking that this isn't a good time to DCA? It's because of the fact that while over the last decade, where many of us have started investing, we think, oh, I can buy a 10, 20% discount and I'm going to be getting a good price. While that was true for the last decade, it's not going to make much sense if you're DCAing very heavily here or utilizing all your capital to quote unquote buy the dip, and then we drop down substantially 30 to 40%. And it sometimes can take years, similar to the dot-com bubble, before you're going to be getting your money back even to break even. That's the key thing here. We don't want to catch a falling knife. We want to wait for the trend to tell us that it's an appropriate time to enter. And we want to see, in this case, as we take a look at the Nasdaq here during the end of the dot-com bubble, we want to see the higher lows and higher highs here. We're not looking to buy the dip here. We don't mind paying a premium, because what we want to make sure is we're going to get in, and it's going to be easy to ride the wave here for the next rally. And the same went here for the secular bull run here. All we had to do is wait here for substantial higher lows and higher highs here. And we were able to ride the wave and buy in at a much better position than most market participants. We were basically buying in at the range here if we bought in that formula with that approach, we bought in where a lot of people were capitulating, right? So again, if you know how to spot those real volatile lows here, if you can wait after one or two relief rallies, sure, you can try buying the dip or starting the dollar cost average. But again, we want to wait for the market to give us the signs that it's time to get optimistic. Now, let's go ahead and talk about the fundamentals because this matters as well. Later on this afternoon, we are going to be getting the U.S. Core PC Price Index, and that is going to give us the year-over-year change for whether or not inflation, or core PCE, one of the ways of measuring inflation similar to the CPI, is going up or going down. Now, I'll go ahead and say it outright, guys, that while a lot of people are absolutely confident that this is going to continue declining, as we are in a downturn right now, and while there's a very good chance of that, don't be surprised if this keeps relatively neutral here. And the big reason why is because the PCE, similar to the CPI, does consider the fact of energy costs, but it also considers food, where futures contracts have gone up over the past month. And on top of that as well, there's medical care and housing. The housing element is the big one here. And the Fed really loves the PCE. You've started to hear Jerome Powell talking about this measurement of inflation versus that of the CPI because it has less of a weight on the big secret that the Federal Reserve doesn't want to, essentially bring attention to. It's the big problem, and it's not energy markets, it's not food prices, it's something that has a much bigger weight, and that is household spending. Now, we'll talk about that as we go through the conversation here, but essentially, the Federal Reserve, getting back to our main topic here, needs to bring at a minimum the PCE to 2%. That has been their key goal here, to bring inflation down, to crush demand in the economy, and put us into a recession. And unfortunately, whether that sounds harsh or not, that is what the Fed needs to do. Later on this afternoon, we should be getting that reading here on September 30th, sometime likely before the market opens or soon after. So essentially, until the Fed can get us down to 2%, this is what we've been drilling here in the channel, that the Fed is going to have to continue to increase the federal funds rate. Whatever the optimistic or target scenario is right now that you've heard from the Fed, it's likely going higher. It has done that time and time and time and time again. They said inflation is transitory. They said that the target federal funds rate will be 3% or 4%, and now it's 5%. It's going to keep going higher here until the data proves otherwise, and Jerome Powell has started to make that very clear. But a couple things that people haven't talked about is the balance sheet. Big thing that people have been just ignoring about, and during these FOMC meetings, there's not enough questions about. And that is something that we need to consider as well. The balance sheet, over $8 trillion, is going to be greatly, in this case, reduced. My apologies. It's going to be going down here. That's going to be negative when it comes to the performance of equities and crypto. So with these two elements that the Fed has in order to tighten inflation in the economy and reduce the money supply, they are going to be a dramatic weight here on stocks and crypto. That is all you need to know until we have any sign that that is going to be able to change these two elements here and therefore give an opportunity for equities and crypto to start moving higher once again. We must be diligent and vigilant in this case. Sorry for my mix-up of English. But essentially, we need to remain vigilant on the trend here. The bears are in the lead right now. So we shouldn't be chasing every single dip in this as if we're going for every falling knife here in the market to try to find every dip buying opportunity. Now, I know some people are excited here about the decline in the dollar index, or the Dixie. We watch this a lot here on the channel, and I think on a TA perspective, this is one of the more optimistic things that the bulls have when it comes to equities and crypto. And potentially the dollar might be topping here. Now, if other central banks were worth their salt and actually started jacking up interest rates as much as the Fed, forcing the Fed to go even higher and actually start doing 100 basis point hikes, doing some really crazy things to finally tighten that inflation versus the 75 basis point hikes that it's doing. That might be something I would be interested in, and that might justify a top in the dollar. But we have had many of these short-term declines here in the dollar over the past year on an exacerbated, exuberant uptrend. What's to say this one won't be any different? And I would like to even make the case that it's not going to be different, because the only reason that the dollar index is declining here is because of three big reasons. And those three reasons are central banks buying their own currency and or dumping US dollars or US bonds. If we take a look across the headlines here, we've got the UK coming out in favor of supporting the British pound after going through a near flash crash in its valuation against the dollar, as the Bank of England has stepped in to buy up government bonds and to essentially provide artificial support for the British pound rather than the dollar. And on top of that, it's not just the Bank of England, it's also China. China has come in with a major stimulus package essentially to defend the value of the yuan. And this is taking inspiration from the first leader of this scenario, which was Japan, to the Bank of Japan coming out and again trying to dump dollars, its dollar foreign currency reserves, onto the open market to artificially suppress the growth of the dollar. Well, I got to tell you guys, folks, this, if anything, gives someone else out there the opportunity to start to change from those weak currencies. It is a form, in my opinion, of, I guess, kind of a wealthy stimulus, or essentially financial relief for the wealthy who know how to play the games of Forex markets and who are ready to get that dollar exposure, because what it does is it just temporarily declines the dollar. And you can see in aggregate they're trying to do it right now when other central banks are doing it. It's a currency war. They're trying to drag down the dollar and kill the trend. But this just gives a lower dip buying opportunity or conversion period where people who own Japanese yen, who own British pounds, who own the Chinese yuan, an opportunity to convert into the dollar and take advantage yet again of another leg up. So this is not substantial or something that is going to reverse the trend. What we need to see here, and central banks can do this, but it's going to be bloody, it's going to be painful. They need to essentially jack up interest rates just as fast, if not faster, than the Federal Reserve and play catch up. That is why the dollar index has gone up so much, because the Fed has been much more aggressive as it is attempting to essentially cool global demand, albeit not trying to wreck the economy so much at the same time. And they've also been reducing their balance sheets, which many economies, the Bank of Japan, ECB, have not been so confident on. Now, this isn't me bashing Europe or Japan. It has to do with the central banks, right? And until these dynamics change, the dollar index will set in likely a higher low or a similar low and bounce up just as strong, because all central banks are doing right now is temporary band-aids. They are not fixing the core issue here. This is why every time we have a decline here, say in something like natural gas, even though, yes, again, another thing for the bulls here, it's looking a bit exhausted, right? At the same time, in the grand scheme of things, we are in an upward ascending channel. Each and every time we come down here to the 200-day moving average, the bulls come in and they drive prices higher. We are still not seeing equilibrium between supply and demand, and that's what the Fed and every other central bank needs to see in order to cool inflation. Now, putting aside energy markets, you guys probably remember when we were talking about inflation here and getting this down to 2%, there is one line item that could likely keep this indicator suspended, even if energy commodities go down, even if food prices continue to go down in the broad scheme of things. The one big thing that we're going to talk more and more about here on the channel is the cost of living. Mortgage rates right now, just as of recent, with the recent federal funds rate hike, have jumped up here from early September around 5% all the way up to 6.7%. This is the highest level since 2002 in over 20 years. Now, there's a lot of people who probably got fixed rate mortgages back in 2021 at those phenomenally low rates before the Fed started to hike interest rates. And for those people, they're in a great position. But there are people who own variable rate mortgages who are feeling the pain of this, people who are buying new homes that are feeling the pain of this, and the people who are renting from those people who took up those mortgages, who are offsetting the cost of that mortgage to their rental tenants, essentially. And that is going to mean the CPI and PCE have a very good chance of going up. You guys have probably felt it here. Whether or not you've got disposable income to go invest in crypto, you need to ask yourself a very important question. If you look around you, is it getting more easier to buy a home, or in this case to rent, in predominantly well-known cities and regions? I don't know about you guys, but the cost of living, at least in the people in my network, is going up. And it's brutally painful. It is absorbing a lot of the spending that people might otherwise put into the economy. And that's why maybe inflationary pressures are starting to dilute a little bit across some of the other things like energy-based commodities and food. But it doesn't mean that people aren't spending more for their lives on a day-to-day basis. And that is going to continue to cause inflationary pressure in the economy. It means that there's still too much money in the system here. If we can have interest rates this high, if people are still taking out mortgages, people are still buying homes in cash, this means that we've got a much bigger problem on our hand, and that essentially means we've got too much money in the system. Anyways, I've rambled on a good amount here, guys. If you enjoyed today's video, consider dropping a like. I'd love to hear what you guys think down below in the comments, whether you agree or disagree with me. If you think I'm being too bearish, you think I'm being too bullish, it's totally fine. I'd love to hear down below in the comments. But until the next video, everyone, thank you all so much for watching. Thank you all for staying tuned here on the channel. I'll see you all in the next one. Take care, everyone.